The Rolex market is collapsing, and I am talking about a full-scale price crash that's wiping out millions in value, turning investments into liabilities, and making people who spent six figures on watches question every financial decision they've ever made. Prices are down, way down, and models that sold for double retail just 2 years ago are now trading below store price. Dealers who stocked up during the boom are bleeding inventory, collectors are panicking, and the waitlists that once stretched for years? Gone. Walk into most authorized dealers today, and you'll find something you couldn't have dreamed of seeing in 2021. Steel sports models, just sitting there, available. So what the heck happened? How did the most stable luxury watch brand in history become the center of a market meltdown? And the question everyone's asking, should you buy a Rolex right now, or is this collapse just getting started? Today, we're breaking down exactly what's happening with Rolex. The 4 major reasons behind the market collapse, the forces that turned scarcity into surplus, and whether owning a Rolex in 2025 is still worth it. By the end, you'll understand why the smartest money in watches is either running for the exits or positioning for the biggest buying opportunity in a decade. Strap in and let's roll and begin with the reasons first. Number 5, the economy turned against luxury. Before I get into this reason, there is something that I need to tell you about, and that's the psychology of owning a Rolex. Let's talk about something nobody admits openly, but everyone understands. Owning a Rolex isn't just about telling time, it's about telling the world who you are, or at least who you want people to think you are. The psychology behind Rolex obsession runs deeper than most people realize, and it's built on layers of human desire that luxury brands have been exploiting for over a century. Status, achievement, belonging, fear of missing out, all of it wrapped in a polished steel case with a crown logo. Rolex is a status symbol, always has been. The brand understood early on that watches could signify wealth and success in ways that clothing or accessories couldn't match. A Rolex on your wrist broadcasts a message. I've made it. But here's the twist. Rolex's genius wasn't just positioning itself as expensive. Lots of brands are expensive. Rolex positioned itself as earned. The brand's marketing shifted in the 1980s from emphasizing technical features to celebrating exceptional people. Explorers, athletes, business leaders, pioneers. The message became clear: Rolex isn't for everyone. It's for people who've accomplished something. So, when people buy a Rolex, they are buying membership into a club of achievers. Research from the University of Michigan found something fascinating about luxury status symbols like Rolex. In certain social situations, particularly when forming new friendships, flashing expensive brands can actually make you less socially attractive. People perceive you as trying too hard. But in business contexts, different story. A Rolex signals competence, success, and seriousness. It opens doors. That duality is what makes Rolex so compelling. It works when you need it to work. Business meetings, negotiations, client dinners. A Rolex on your wrist adds weight to your presence, even if nobody consciously notices it. Then there's the exclusivity factor. Rolex has mastered the art of controlled scarcity. The brand produces enough, never fully satisfies demand. That gap between supply and desire creates psychological tension. You can't walk into a store and buy the watch you want. You have to wait, build relationships, and prove yourself worthy. That manufactured difficulty makes ownership feel like an achievement. When you finally get the call from your authorized dealer, it's not just a purchase, it's validation. You've been chosen. And that feeling, that's what keeps people coming back. But let's go deeper, because Rolex doesn't just sell status. It sells permanence in a disposable world. Think about the objects in your life. Your phone will be obsolete in 3 years. Your car will depreciate the moment you drive it off the lot. Your clothes will go out of style next season. But a Rolex is forever, or at least that's the promise. Rolex watches from the 1950s and 1960s are still running, still valued, still desired. That longevity taps into something primal, the desire to own something that lasts, something that can be passed down, something that transcends trends. In a world of planned obsolescence, Rolex offers the opposite: timelessness. And then there's the emotional connection. For many people, a Rolex marks a milestone. Graduation, first big promotion, retirement. It becomes a physical reminder of achievement, tied to memory. and meaning. You look at your wrist and remember where you were when you earned it, who you were becoming, what you overcame to get there. So Rolex became a symbol and a legacy. But here's where it gets messy, because during the boom years, all of these genuine psychological motivations got hijacked by speculation. People started buying Rolex not because they loved watches, not because they wanted to mark achievements, but because they saw profit. The emotional connection was replaced by spreadsheets and resale calculations, and that changed everything, as you'll see. This was an accident Rolex didn't plan for. For a brand that didn't become who they are by accident, it seemed like Rolex was blindsided by these reasons behind the market crash. Or were they? Because if there's what Rolex knows how to do, it's dominance, calculated moves, relentless consistency, understanding human psychology, and also adapting. As technology evolved, so did Rolex. Instagram, YouTube, and watch forums turned Rolex into a lifestyle brand for a new generation. Influencers posted wrist shots, rappers name-dropped models in lyrics. TikTok exploded with watch content. Suddenly, knowing about Rolex wasn't niche collector knowledge. It was mainstream. Gen Z, millennials, even teenagers knew what a Daytona was. They recognized the crown logo. They understood that Rolex meant something. The brand's visibility skyrocketed without Rolex spending $1 on social media advertising, and that visibility created desire, and from 2017 to 2022, Rolex wasn't just hot, it was untouchable. Prices on the secondary market exploded. A stainless steel Daytona that retailed for $14,000 and was selling for $40,000, sometimes more. Submariners, GMT Masters, even Datejusts were trading at premiums that made zero logical sense. But logic didn't matter. Demand was insane. The turning point? October 26, 2017, when actor Paul Newman's personal Rolex Daytona, the one he wore in photos for decades, sold at auction for $17.8 million. That single sale rewired how people viewed Rolex in the mainstream. People began to see them as assets, investments, and items they could buy, hoard or hold and flip for profit. Rolex became a status symbol, a financial bet, and a cultural phenomenon all at once. But then 2022 arrived, and everything broke. No matter the symbol or status, in the end, Rolex watches are discretionary purchases. You don't need them, you want them, and when the economy tightens, those wants get cut first. After the mess of COVID, in 2022, inflation hit levels not seen in decades. The US inflation rate peaked at 9.1% in June. Gas, groceries, housing costs, everything was skyrocketing. Central banks responded by raising interest rates aggressively. The Federal Reserve hiked rates from near zero to over 5% in less than 18 months. Higher interest rates have consequences. Borrowing becomes expensive, stock markets wobble, crypto crashed spectacularly. Tech stocks, which had minted a generation of newly wealthy buyers, tanked. People who felt rich in 2021 suddenly felt a lot less confident in 2022. Luxury spending pulled back hard. Not just watches, supercars, high-end real estate, designer handbags, the entire luxury market felt the chill. Rolex, despite its prestige, wasn't immune. But there's another layer. The people buying Rolexes at inflated prices during the boom weren't traditional collectors. Many were speculators. They saw Rolex as an investment vehicle, a way to park money and generate returns. When inflation spiked and interest rates rose, traditional investments like bonds suddenly offered real yields again. Why risk money on a volatile watch market when you could earn 5% risk-free in a treasury bill? The speculative money dried up, and when speculators exit, liquidity collapses. Add to that the geopolitical instability. Russia's invasion of Ukraine disrupted global markets. Energy prices spiked. Supply chains, already strained from the pandemic, struggled further. China's zero-COVID policy kept one of the world's largest luxury markets locked down for months. By late 2022, the economic environment had shifted from euphoria to caution. Consumers tightened budgets, and luxury watches, symbols of excess, became harder to justify. The economy turned, but that alone doesn't explain the scale of the collapse. Because while demand was falling, something else was happening on the supply side, and it made everything worse. Number 4. Rolex quietly increased production. Rolex doesn't publish production numbers, never has, but industry insiders estimate the brand produces around 1 million to 1.2 million watches per year, possibly more. And during the pandemic boom, Rolex ramped up. For years, Rolex operated under a scarcity model. Limited production, long wait lists, exclusive allocation. It kept demand high and brand prestige intact. But when the market exploded and gray market dealers were making fortunes off premiums, Rolex saw an opportunity. Reports suggest Rolex increased production capacity significantly between 2020 and 2023. New manufacturing facilities, expanded shifts, streamlined processes. The goal was to meet surging demand and reclaim some of the profit gray dealers were capturing. But here's the problem. Rolex increased supply just as demand was about to crater. By the time the extra watches hit the market in 2022 and 2023, the economy had turned, speculative buyers had disappeared, and suddenly there were more Rolexes available than buyers willing to pay inflated prices. Authorized dealers who'd been operating with empty display cases for years suddenly had inventory. Not huge amounts, but enough to change the dynamic. The scarcity narrative cracked, and once buyers realized they didn't need to pay premiums or wait years, gray market prices collapsed. This is a classic supply-demand overcorrection. Rolex spent years undersupplying the market, then increased production right as the boom ended. The timing couldn't have been worse. Rolex flooded the market at the worst possible time, but even that doesn't fully explain the brutality of the crash. Because there was another factor at play, one that nobody saw coming until it was too late. Number 3. The gray market imploded. The gray market, the network of independent dealers buying and reselling Rolexes outside authorized channels, was the engine of the boom. These dealers paid premiums to acquire watches, marked them up further, and sold to buyers desperate for instant access. But the gray market operates on leverage. Dealers borrow money to buy inventory, betting they can flip it quickly for profit. During the boom, this worked beautifully. Watches moved in hours, sometimes minutes. Capital turned over fast, profits were massive. Then the market turned, and leverage became a death sentence. As prices started falling in 2022, gray dealers faced a nightmare scenario. They'd borrowed money to buy inventory at peak prices. Now that inventory was worth less than they paid, and buyers had disappeared. They couldn't sell without taking losses, but they had to sell to repay loans. The result was a liquidation spiral. Dealers dumped inventory at whatever price they could get. Each sale pushed prices lower, which forced more dealers to sell, which pushed prices lower still. Classic market panic. Some of the biggest names in the gray market got crushed. Dealers who'd been buying aggressively, confident the boom would continue, suddenly found themselves sitting on millions in depreciating inventory with mounting debt obligations. A few went bankrupt outright. The gray market's collapse removed the price support that had been propping up valuations. Without dealers willing to buy, secondary prices had nowhere to go but down. And here's the kicker. Rolex itself contributed to the gray market's demise. The brand started cracking down on flipping. Authorized dealers were instructed to track buyers, identify those reselling immediately, and blacklist them. Some dealers even required signed agreements stating buyers wouldn't resell for a certain period. But here's the big question. Did flippers crash the Rolex market? Number 2. Flippers' role. Let's answer the question directly. Did flippers crash the Rolex market? Yes and no, but mostly yes. I have talked about it briefly before the number 3 reason, but let's get into the details. Here's the uncomfortable truth. Flippers didn't create the boom, but they absolutely accelerated it. And when the market turned, they triggered the crash that followed. Let's define terms. A flipper is someone who buys a watch with zero intention of keeping it. They purchase at retail, immediately list it on the secondary market, and pocket the difference between retail price and gray market premium. It's pure arbitrage. Buy for $15,000, sell for $35,000, and keep the $20,000 difference. Rinse and repeat. During the boom, flipping became an industry. Not just individuals making side money, but organized operations with multiple dealer relationships, sophisticated networks, and serious capital. Some flippers were on waiting lists at dozens of authorized dealers simultaneously. They used fake email addresses, shell companies, and proxy buyers to circumvent limits. One watch enthusiast reported that a friend bought 7 Omega Speedmasters under different aliases. Another took a gifted watch and flipped it for double the retail price. It was pure commerce, and for a while, it worked beautifully. Gray market premiums were so high that flipping was virtually risk-free, and more people got into it because of the profit margin. Authorized dealers noticed. Some played along, rewarding high-volume customers who'd earned access to coveted models through purchase history. The system rewarded flipping. Sales associates earned commissions on ancillary products, not on steel sports models, so they had financial motivation to string customers along, encouraging them to keep spending while dangling the possibility of that Daytona allocation. This created a vicious cycle. Real collectors, people who actually wanted to wear the watches, got squeezed out. They couldn't compete with flippers who had deeper pockets and more dealer relationships. Waitlists ballooned to absurd lengths, 5 years, 10 years, maybe never. Meanwhile, gray market dealers were sitting on mountains of inventory. Brand new, unworn Rolexes that had been flipped within days of purchase. The gray market wasn't a secondary market for used watches anymore. It was a parallel retail channel charging premiums that sometimes reached 100% or more above retail. This was how the boom happened, because there's a psychological part to owning or dealing in Rolex. I'll explain that day later on in this video. Basically, if someone paid $45,000 for a Daytona this month, the next seller wouldn't accept less than that. Prices flew upward, each transaction justifying the next. Media coverage amplified the frenzy. It was a classic speculative bubble. Prices are rising because people believed prices would keep rising. And as long as liquidity remained strong, as long as buyers kept paying, the game continued. Then 2022 arrived. I have told you about all that happened that year in reason number 5. Remember the bit about the interest rate, inflation, and stock market? Yes, that one. Because of that, the speculative capital that had been funding watch flipping evaporated. Flippers who'd been operating on leverage, borrowing money to buy inventory with the expectation of quick flips, found themselves trapped. Watches that had been moving in hours now sat for weeks. Buyers disappeared, and the flippers still had loans to repay. Panic selling began. Flippers dumped inventory at whatever price they could get. Each sale pushed prices lower, which forced more flippers to sell, which pushed prices lower still. The same momentum that drove prices up now drove them down. Faster. Morgan Stanley analyzed the gray market and found exactly this pattern. The number of brand new, unworn Rolexes listed on secondary platforms collapsed as flipping became unprofitable. The flipper exodus created a supply shock. All that inventory they'd been hoarding hit the market simultaneously. Dealers who'd built businesses around flipping suddenly had too much stock and not enough buyers. Some went bankrupt, others slashed prices just to stay solvent. Watchfinder, one of the largest pre-owned dealers owned by Richemont, reported that turnover dropped 19.3% in the financial year ending March 2023. The value of their inventory fell 23.6%. They posted operating losses of £12,000, and they weren't alone. Across the industry, dealers faced the same crisis. Too much inventory purchased at peak prices, not enough buyers, and a market in free fall. So did flippers cause the crash? They didn't cause the underlying economic conditions. Inflation, interest rates, crypto collapse, those were macro forces beyond the watch industry's control. But flippers absolutely amplified the volatility. They created artificial demand on the way up by treating watches as financial instruments rather than collectibles. And they triggered the liquidation spiral on the way down by dumping inventory to cut losses. Without flippers, the boom would have been smaller. Prices would have risen, but not to such absurd levels. And the crash would have been gentler, a correction rather than a collapse. But here's the final twist. Flippers might have done the market a favor. You probably think I have lost it, but let me explain. The crash purged speculation. It scared away people who viewed Rolex as easy money. It restored some sanity to pricing. And it forced Rolex to confront the monster it had indirectly created. Rolex responded by cracking down. Authorized dealers now track buyers more carefully. Serial numbers are monitored. Flippers get blacklisted. The brand even launched a certified pre-owned program to reclaim control over the secondary market. The era of easy flipping is over. Margins are thin, risks are high, and genuine collectors are finally getting access to watches again. However, while flippers were panicking, Rolex itself remained silent, and that silence spoke volumes. Number 1. Rolex's silence and strategy. Luxury brands live and die by perception, and Rolex's greatest strength has always been its mystique. The brand doesn't advertise much, doesn't engage with speculation, doesn't comment on market trends. It simply exists, aloof and unshakable. But during the crash, Rolex's silence became a problem, or did it? As prices tanked and collectors panicked, the brand said nothing. No reassurance, no explanation, no acknowledgement that anything unusual was happening. Some interpreted this as confidence. Rolex doesn't react to short-term volatility because it operates on a century-long timeline. Others saw it as arrogance, a brand disconnected from the financial pain its customers were experiencing. However, that silence didn't mean no reaction or action. Rolex preferred to act than to be chatty, and so there's a strategic angle here. Rolex doesn't want its watches treated as investments. The brand's official position has always been that Rolexes are timepieces, tools, objects to be worn and enjoyed, not financial assets to be flipped for profit. The boom created a class of buyers Rolex didn't particularly like, speculators with no real passion for watches, buying purely for resale. These buyers drove up gray market prices, making Rolexes inaccessible to genuine enthusiasts. They also created volatility, turning a stable luxury brand into something that resembled a speculative commodity. By letting the market crash without intervention, Rolex effectively purged the speculators. Gray market premiums disappeared, flippers got burned, and the brand returned to a more sustainable model where watches were available at retail to people who actually wanted to wear them. It's a long-term play. Rolex is betting that short-term pain will lead to long-term stability. Whether that works depends on how collectors and buyers respond. Rolex stayed silent because they had a plan. But while the brand was playing the long game, buyers were left with a brutal short-term reality. And that raises the biggest question of all: should you buy a Rolex right now? Should you buy a Rolex in 2025? This is where things get complicated, because the answer depends entirely on why you want a Rolex in the first place. If you're buying a Rolex as an investment to flip for profit or hedge against inflation, the short answer is no. The market has fundamentally changed. The days of guaranteed appreciation are over. Yes, certain rare vintage pieces will always command premiums. But modern steel sports models, the bubble has burst. Prices might stabilize, but expecting them to double anytime soon is wishful thinking. Investment-grade watches still exist. Patek Philippe, Audemars Piguet, certain independent brands. But Rolex, at least for common references, is no longer a reliable investment vehicle. However, if you're buying a Rolex because you love watches, appreciate the craftsmanship, and want to wear it, this might be the best time in years to buy. Here's why. Prices are down, availability is up. You can actually walk into authorized dealers and find models that were impossible to get during the boom. No wait lists, no begging, no buying jewelry and leather goods just to build purchase history. You can buy the watch you want at retail and walk out the same day. And let's be honest, Rolex still makes phenomenal watches. The movements are robust, the build quality is exceptional, the brand's after-sales service network is unmatched. A Rolex Submariner or GMT Master is a tool watch you can wear daily for decades. It'll keep accurate time, survive abuse, and still look great. From a pure value perspective, buying at or near retail makes sense. You're paying what the brand thinks the watch is worth, not some artificially inflated gray market premium. If you wear it and enjoy it, the financial aspect becomes secondary. But there are risks. Prices could fall further. If you buy a Submariner today at $10,000 and $250,000 in retail and the secondary market drops to $8,000, you're technically down. But if you're not planning to sell, does it matter? So here's my take. Buy a Rolex if you love it. Buy it because you'll wear it, appreciate it, and keep it for years. But don't buy it expecting to make money. Don't buy it as portfolio diversification. And definitely don't buy it thinking it's a safe store of value. The market has spoken, and what it's saying is clear. Rolex is a luxury product, not a guaranteed investment. Whether you should buy depends on your reasons, but understanding the market is only half the story. Because while we've talked about what happened and why, there's one more question that matters. What happens next? What comes next? Predictions for the Rolex market. Predicting the future is risky business, but looking at current trends, here's what's likely. In the short term, prices will probably stabilize around current levels in 2026. The panic has passed, the speculative froth has been skimmed off. What remains is a more rational market where prices reflect actual supply and demand rather than FOMO and hype. Some models will hold value better than others. Iconic references like the steel Daytona, the Pepsi GMT, and certain vintage pieces will always command premiums, though not at 2021 levels. Everyday models like the Datejust or Oyster Perpetual will trade closer to retail, maybe slightly below. For midterm predictions, which is from 2027 to 2030, Rolex faces a generational shift. Younger buyers, Gen Z and millennials, have different values than previous generations. They care about sustainability, brand ethics, and digital experiences. Rolex's traditional model, built on exclusivity and heritage, needs to evolve. The brand has already embraced pre-owned sales, creating an official certified pre-owned program. This has given the brand control over the secondary market, ensuring quality and authenticity while capturing revenue they're currently losing to gray dealers. Others believe Rolex will lean harder into customization and personalization, offering bespoke options that make each watch unique. This could reignite demand among younger buyers looking for individuality. For my long-term prediction, beyond 2030, Rolex's future depends on how successfully it navigates changing consumer preferences and economic realities. The brand's core strengths remain intact: unmatched recognition, exceptional quality, a century of history. But complacency is dangerous. Ask Kodak, Blockbuster, or BlackBerry how resting on past success worked out. The smartest prediction? Rolex will remain relevant, but it'll look different. More accessible, more transparent, more attuned to modern buyers. The mystique will evolve, but the brand will endure. As for investment potential, forget it. The era of treating Rolex like stocks is over. Future appreciation, if it happens, will be slow and tied to genuine scarcity, not artificial hype. The future is uncertain, but one thing is clear. The Rolex market of 2025 looks nothing like 2021, and the people who understand that are the ones who will make smart decisions. So where does that leave us? The bottom line: what you need to know. Let's bring it all together. The Rolex market collapsed because of a perfect storm. Economic downturn, increased production, gray market implosion, and speculative excess. The boom was unsustainable. The crash was inevitable. Prices fell hard, waitlists vanished, availability improved, and the narrative around Rolex as a guaranteed investment died. For buyers, this is actually good news. If you want a Rolex to wear, there are now better opportunities than any year since 2019. You can buy at retail, get the watch you want, and skip the gray market entirely. For investors, the message is clear: move on. Rolex is no longer a reliable wealth storage vehicle. If you're chasing returns, look elsewhere. For collectors who bought during the boom, the pain is real. You're underwater. But if you bought for love of the watch, not profit, then wear it and forget the market. Your enjoyment shouldn't be tied to resale value. The Rolex collapse is a reminder that even the most iconic brands aren't immune to market forces. Scarcity, when artificial, eventually corrects. Speculation, when excessive, always crashes. And value, real value, comes from intrinsic quality, not hype. So, should you own a Rolex? If you love watches, appreciate craftsmanship, and want something that'll last decades, yes, absolutely. But if you're buying for profit, for clout, or because TikTok told you it's a smart investment, save your money. The game has changed, and the winners now are the people who buy for the right reasons. The Rolex story is far from over. The brand will adapt, the market will evolve, and new narratives will emerge. But the lesson from this collapse is timeless. Nothing goes up forever. Not prices, not demand, not hype. If any of this surprised you, or if you've got your own Rolex story to share, drop it in the comments. Are you buying in the dip, selling while you still can, or just watching the chaos unfold? Let us know. And if this breakdown helped you understand what's really happening in the watch market, hit that like button and subscribe. Because the luxury world is full of stories like this. Brands that rise, fall, and fight to stay relevant. And we're here to break it all down. Some markets survive their crashes, some don't. As for Rolex, time will tell.